All right, guys, the Fed has raised interest rates by a quarter point. The markets went up, then down, then back up again, but they're off their highs of the day. Do I care?
No.
Mo, I do not care. Why do we not care?
I didn't know until we walked in here and Tim was watching it on TV. I go, what happened?
Yeah, you didn't know they raised rates?
No.
So I guess things are going up, though, because they've indicated that there's going to be more dovish.
They're going to pause, allegedly. But they did. I'm reading the statement right here. They did say some things that I'm like, that's not good. Tighter credit conditions for households and businesses will likely weigh on the economy. Hiring, inflation, the extent of these remains uncertain. That's a big word, I think. They're going to trust the data going forward. It doesn't necessarily, I think a lot of people took it as they're going to stop hiking rates. And I don't necessarily think that's what that means. They may pause.
So remember, people hear things the way they want to hear things, right?
Yeah.
I did not listen to this thing at all because I could not care less. I probably should care more because of the channel. But I look at it saying, okay, where are rates right now?
Five to 5.25.
Right. Is that absurd for history?
No.
It's absurd for the last 5-10 years.
Yeah, for the last decade, it's absurd.
15 years, actually 15 years.
I think it's pretty arguable that zero was absurd, but
that's the thing. Exactly. Like zero was absurd. Yeah. And we kept talking about, it's funny because everybody's justification for high valuation in the stock market was, listen, if rates are zero, you can justify, like Warren Buffett even says it, but people didn't listen to the other part. If you knew rates were going to be this low forever or 50 years, you can really justify higher prices, right? But I don't think you'd find anybody who really thought that rates would be this low for 50 or 60 years.
No.
And eventually something was going to happen that caused rates to go back up. And in that situation, it was inflation. And the way you fight inflation, when you have low unemployment, you have costs going higher like we had because of the COVID transportation, all these costs coming in.
Supply chains and stuff.
Supply chains. How do you fight it? You fight it with interest rates, higher interest rates. That's what we did in the 80s. That's how you fight inflation. When you fight inflation with high interest rates, people borrow less money, they spend less money, things get a lot calmer.
Yep.
And it's worked so far.
It has.
I mean, inflation is a lot lower.
Down.
If you look at the month-to-month change in inflation over the last year, over the last 9 months, it's been a lot lower than before. And mission accomplished. The question is that going to, we still see things like rates, 2.5% on homes, 2.5% on homes going to 7%. You wonder yourself like, okay, that's going to hurt housing. Well, then you hear it's still a supply issue. Yeah. This is what I always talk about. It's supply and demand that you have to really think about whenever you look at any situation. It's not just demand, not just supply.
If you would have just told me isolated and said, Mo, in a year from now, interest rates for a home are going to be 7%, I'd be like, oh, that's going to be a big pullback in the market.
Yeah, we've talked about this before. We've said, listen, talking about this, but then you have to realize that there's a supply issue. So with the Fed raising rates, I think I feel bad for Jerome Powell. We've talked about this in my past videos when we looked at Jerome Powell when he spoke to the Senate and the House of Representatives. And I said, man, I really respect this guy a lot more now. Why? Because he was getting blasted on all sides. Guys, we have really low unemployment. That is a big driver of inflation. So if you want to keep that low unemployment, you got to have high interest rates, right? And I don't think that's going to happen. Well, I shouldn't say that. If you want to keep low unemployment, you're going to have inflation. In order to fight inflation, you have to have interest rates being higher. At 0% interest, you are begging for just willy-nilly things to just go crazy, right? And that could be okay temporarily, but rarely in history have you seen a mass printing of money. And that's what they do. When you want to control inflation, it's printing money or decreasing the money supply because that's increasing the interest rates that cause these things to happen, okay? If we doubled the amount of money that was out there tomorrow, literally handed it to people, what would happen to the cost of everything?
Skyrocket.
It would skyrocket. It would absolutely skyrocket. It's not just I was wrong back in 2008. I thought all this printing of money would lead to inflation. I don't know what happened. Maybe it did lead to inflation because we would have had deflation if it wasn't for that. But then I realized, okay, well, wait a second. The money didn't go to the people. They went to the banks. Maybe that was the reason. Yeah. But in COVID, we just gave people money.
Yeah.
When you give people money, they're going to spend. And they're going to say, I don't really want to work because I'm getting $600 a week from the government. In order for me to work, you got to pay me more. Causes wages to go up. Causes inflation.
Yeah.
So with the Fed and Powell, I think he's also trying to
He's playing the balancing act.
He's got to.
He has to, yeah.
He has
Still
to.
said their inflation target is 2% over the long run.
So can we pull up CPI over the last CPI by month? Let's look this up. And here's the Bureau of Labor Statistics. Shoot, now I got to find this thing. HTML. Here we go. Okay. So we're at 5% for the 12 months ended March 2023. 1, 2, 3, 4, 5, 6. The 7 months. Oh, wow. Okay. Some big numbers in there, but also some low numbers in there, which is about average right here. So 0.9, 1.1, 1.2, 1.7, 2.1, 2.2 divided by 7 is 0.3 times 12 is 3.6%. We're roughly at 3.5 to 4% annualized when you look at the last 9 months. Okay. All right. That's historical inflation is 3 to 3.5%. Okay. We're back down there. Now, why do they want 2%? I don't know where this 2% thing came from.
I cannot figure it out. I don't know why.
Has
that's
it
the
always
target.
been 2%?
I don't think so. But they are just fixated on this 2% number. And I don't understand why.
Because if you look at let's look at historical CPI by year. Consumer Price Index 1913. Okay, so it was at 9.9 to 309.6, 110 years later. Did I get that right? 309.6 divided by 9.9 to the 0.01. 3.5%, right in the nose.
I don't see where the 2 is coming from.
Right in the nose, 3.5%. And we've had I don't know.
I don't know either. But he said it again multiple times. He even said it when I walked in the studio. It was on television. I heard him say it multiple times in passing. So they're going for 2%.
Yeah, that's interesting.
Strongly committed to returning to the inflation of 2%. That's the objective.
But it literally on the nose is 3.5% going back to 1913. And again, the government, the economy is very different today than it was back in 1913. But I'd be interested to see how 20-year periods look differently now versus back then. But the whole point is, I don't know where this 2% comes from, but in order to have 2% inflation, I think you got to be tighter on your monetary policy. What I mean by that is really be quick to move up rates if inflation starts to rear its ugly head. Mm-hmm. I know the last 15, 20 years has been very low inflation. I mean, if you just looking at it from a glance here, take out the last 2 years, look, there's many years starts with a 1 and 2 or a 0.
Yeah. I think that I don't think they're going to start cutting anytime soon. And the reason B's, because if they start cutting and then they do what you said and inflation starts to pop up and they have to revert, I think that looks worse than going from pause to increasing rates.
You think
just
so?
The optics of it.
Maybe you're right. But
That's
if they pause and a recession does hit, they'll have an excuse to cut.
If they pause, I think it's the best situation for their optics.
Oh, well, of course. The best situation for the optics is for them to cut.
Well, no, I think if they start to cut, inflation starts to take off, then they revert to raising. I think that's an issue.
I got you. I follow what you're saying now.
That's where it looks bad.
So random statement here. Remember in past videos I talk about housing prices and how housing prices can still go up with inflation, even with rates going up. Back in 1975, the average home mortgage was 9%. Let me actually be able to write on there instead of breaking my screen. So the average mortgage rate was 9%. Back in 1975. In 1984, it was 13.5%. That's an increase of 50%. Now, the average home price in 1975 was $32,600, and the average home price was $81,000 10 years later. So almost tripling. Look at 75 to 85. Well, if you include 9%, to 3.5%. Look at the stretch here. 9.1, 5.7, 6.5, 7.6, 11.3, 13.5, 10.3, 6.1. Those are big jumps. Big jumps. Huh. So you had an economic recovery happening here, right? And I look at that saying, guys, inflation is real estate's friend. And I've said this before. And I said in a previous video, I wasn't thoroughly convinced, not because of supply issues, I thought with inflation helping real estate prices, I wasn't convinced that real estate prices would fall. I keep hearing people say, I'm waiting for the crash in real estate. I'm waiting for the crash. Guys, we had one nationwide crash in real estate in history. Not saying it couldn't happen again. But I do see a difference. I see a major difference in home lending standards today than I did back in 2004, 5, 6, 7. Way different. Way different. I also see the cost of things going up.
Yeah.
That's going to help housing prices.
Yeah.
You have all these things working together. You know, as a nation, we never went down in real estate prices as a nation for a year until like 2007, 2008. That might be where we go again. We still might not have, we might have nationwide prices still going up.
Yeah.
So with this whole Fed stuff, we want you to really pay attention to our videos and subscribe. Oh, and by the way, we have a webinar Thursday,
Tomorrow.
6 p.m. Tomorrow, 6 p.m. Eastern time, where we will teach you how to make extra money on the stocks in your account with options or get paid to wait for stocks to hit the prices you want. So imagine that. Stocks you have in your account, they go up and down. You get dividends, but also we'll teach you how to use options to make money on them. And while you wait for stocks to go to the price you want, you can make money for waiting for that. So anyways, back to our conversation. Sign up the link below, the description below. I'm looking at this saying, if a recession does hit, usually in recessions, the Fed's going to cut rates. It would just be weird if they went from this low rate to this high to cutting again, but maybe that's what they need to do.
Maybe. But also understand, if people put a lot of emphasis on the Fed and what they're going to do as far as raising rates. It's very multifaceted, as we just talked about. There's a lot of things that go into this. Don't just look at one thing and say, oh, this is what it's going to be, and this is what I'm going to base my decisions off of.
Oh, yeah, you can't do that.
I think that's what it kind of seems like a lot of people do. They get very excited for what the Fed's going to do, and they run with it.
Yeah, guys, everything is short term. I just had a friend of mine in my office, Mo and I were talking to him, and we were talking about Southwest Airlines, and he said, well, you know, I think there's a service has sucked because of lately with them. It's like, okay. Like, I was like, do you think, I looked at him, I said, do you think that's temporary or permanent? He goes, I think it's temporary. I said, I agree.
Yeah.
Right? And I sat there and said, I agree. And my point was like, I think the stock is selling and don't go buy the stock because of what I'm saying. But the whole point about it is, I think the stock is cheap because the service issues have affected profit. And I look at that saying that's probably a temporary thing. That's what you need to have happen in order to get good deals on things. You need temporary bad things to happen to good companies. And I think that's there for, same thing with the US. Temporary bad things going to happen to a great country, right? Don't worry about the day-to-day changes and who cares what happens with the Fed? Who cares? Look at the interest rates that happen here. We had 18% interest rates back here, or 19, whatever, 15 to 18% interest rates. That's pretty bad, right? And guess what? 1980 was the start of a massive economic boom for the US, a 20-year economic boom. Right? So you sat there and said, look how terrible the country is. We have 15, 18%. Yeah, we had 20%. Every time you see things that you think are bad, they usually drive down prices so much that they only get better. That's what I want you to focus on. So that makes sense to you. If you are smart and you realize that makes sense to you, subscribe to our channel. If it doesn't make any sense to you, I think you know what I'm trying to tell you. I don't think you're very smart then. But I know people watching us, it makes sense. And I want you to share this video with some people out there who might get in some knowledge from that. And by no means are we saying that we're correct on a lot of things. You know, we're wrong on a lot of things. But the way which we look at things is pretty fundamentally sound, right?
Yep.
It's sitting there saying what matters is the long run. You don't divorce your spouse because you get in one fight. Even if it's a colossal fight, you don't divorce your spouse. Heck, a lot of people have a spouse cheat on them, they still don't divorce them because they want to work on it. That's one of the ultimate things that you could do, apart from like your spouse trying to kill you, and you say, you know, let's work on it. But I look at that saying, the Fed's going to do a bunch of things. Companies are going to do a bunch of things. Go look at the history of what the U.S. does and what individual companies do. And rarely are the short-term problems, blips, going to cause a downfall. It's just an opportunity to do better. That's what I want you to do. So guys, again, thank you very much. Description below for our free webinar tomorrow, 6 p.m. Eastern time. Take care.